Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today, we are going to talk about WVE. Wave Life Sciences Ltd, WVE, is presenting one of the most compelling asymmetries we've seen in the biotech sector all year. I mean, this company is sitting at a really pivotal inflection point where you have this truly disruptive RNA innovation meeting some exceptionally noisy and complex market dynamics.
And we absolutely need to anchor ourselves in the current reality of that noise. Look, the stock is trapped. It's in this narrow trading range, hovering somewhere between $7 and $7.50 as of, December 2025. And yet, the consensus among analysts is that the fundamental value dictates a price target much closer to $20. That's a staggering potential upside. We're talking over 170%.
It is staggering, but the technical forces at play are they're undeniable. We aren't talking about a sleepy stock here. The microstructure tells us that this market is highly polarized. You have a high short interest, I think it's exceeding 15% of the float, and critically, off-exchange trading volumes are consistently running above 50% of the daily activity.
Right. And that concentration of short volume operating out of sight in the dark pools, that is the central issue for me. So the core question we really have to address is whether the stock's valuation right now is genuinely being driven by the, I'll admit, stunning clinical success of its pipeline, specifically that WVE-007 program, or if it's the technical market microstructure, the concentrated skepticism, and the financial reality that are the dominant forces defining this suppressed price.
Well, my stance on this is firm. The fundamental, the biological value is overwhelmingly clear and, frankly, scientifically de-risked. The market is it's failing to price this innovation efficiently. This is a temporary suppression of what is a massive future opportunity.
And I approach this a bit differently. I believe the microstructure headwinds, the significant execution risks inherent in any biotech, plus the current valuation complexity and the harsh financial needs of the company. I think all of that is currently outweighing the future commercial potential. They're creating a structural ceiling that the price just struggles to pierce, no matter how good the data looks on a slide.
Okay, so my core thesis, and this is really the key, it centers on the market fundamentally mispricing a biological achievement that solves the biggest commercial limitation of the multi-billion-dollar GLP-1 obesity market. We're calling this the muscle preservation narrative, and the evidence for it is pristine. It comes directly from the interim phase 1 ENLIGHT trial data for WVE-007, which is an activin E silencing agent. So what did we see? Patients receiving just a single dose of WVE-007 showed two simultaneous and critical outcomes: a statistically significant increase in lean muscle mass of 3.2% with a p-value of 0.01, coupled with a substantial 9.4% reduction in visceral fat. This combination, it's revolutionary.
Revolutionary perhaps, but let's just pause on the context. Why is that muscle preservation so important?
Because it's the central flaw of the current standard of care. I mean, when patients use popular GLP-1 agonists, they achieve weight loss, yes, but often 20 to 40% of that weight loss comes directly from lean mass. That's muscle atrophy, it leads to sarcopenia and metabolic instability. WVE-007 appears to completely prevent this catabolic effect. This positions it not just as a competing therapy, but potentially as the ideal adjunct to existing GLP-1s, or maybe even a superior standalone treatment. You're combining fat reduction with critical muscle maintenance. And this clinical success, it has translated directly into institutional conviction. Just look at the accumulation. FMR LLC, Fidelity, they increased their position by over 700% in Q3 2025. This high conviction buying by sophisticated long-term players establishes a serious, deep institutional floor for the stock. They're anticipating the eventual realization of this clinical alpha.
That's a compelling story, I'll grant you, but that institutional buying action, while it's noteworthy, it's largely irrelevant to the immediate price action because the stock's valuation is currently being defined by technical suppression and financial realities. This is a technical short play, and the data supports it. The 15.86% short interest is aggressive, sure, but the more concerning figure for me is the 55.6% off-exchange short volume ratio. So what does that ratio mean for the average investor? It means that more than half of the short-selling volume is happening in dark pools. It's happening behind the scenes. This signals active, concentrated, institutional bearish positioning that is deliberately designed to neutralize any upward price pressure. They are absorbing that FMR buying without triggering a visible price spike on the lit exchange.
And furthermore, we just cannot ignore the tangible financial mechanism that aids the bears: the company's heavy reliance on its at-the-market, or ATM, equity facility.
But the ATM provides a runway to 2027. That's a good thing, isn't it?
A runway is extended, yes, but the ATM is a structural headwind. For those who might not be familiar, the ATM isn't some massive one-off secondary offering. No, it's a constant slow drip of newly issued shares, often in the millions, that the company sells directly onto the open market every time the stock bumps up. They are selling shares in that $7 to $8 range to fund their operations. This consistent infusion of new supply provides an active structural price ceiling and confirms that the company is still deeply dependent on R&D funding, burning, $45.9 million in Q3 2025 alone? So when you look at recognized revenue, the 10.8 times price-to-sales ratio is significantly higher than the U.S. pharmaceutical industry average of 4.0. This provides critics with clear ammunition that the stock is fundamentally expensive based on current metrics, even if we acknowledge future potential. The technical reality is currently overriding the biological potential.
I have to disagree that the technical realities outweigh the science, because the science for WVE-007 is already strongly de-risked, and not just by those interim results. We have validation on multiple levels. So firstly, the biological hypothesis is backed by human genetics. We know that naturally occurring loss of function variants in the INHB target are associated with reduced visceral fat and a favorable metabolic profile, specifically without the detrimental effects on muscle mass. We are not gambling on an unknown target here. We are leveraging a pathway that nature has already proven works in humans.
That is a compelling argument that you're following nature's blueprint. I'll give you that. But let's talk about the data that is fueling this $20 valuation target. The celebrated muscle preservation data, that 3.2% lean mass gain. It comes from a specific dose in a very small phase 1 cohort. We are talking about N equals 24 patients. While that's statistically significant for phase 1, sure, relying on an initial signal from such a tiny sample size for a multi-billion-dollar paradigm shift valuation, that's where the market introduces extreme risk.
Why is that risk any different for WVE than for any other successful biotech that starts with small phase 1 results? I mean, you have to start somewhere.
The risk is magnified because biotech history is littered with promising initial data that failed spectacularly to replicate or show sufficient differentiation when moved into larger pivotal phase 2 trials, especially in metabolic disorders. You are asking the market to pay a premium today based on a spectacular hypothesis that has been proven in 24 people. That $20 price target implies certainty. I would argue that until you show that 3.2% lean mass gain is reproducible and safe across hundreds of patients in phase 2, this is fundamentally a bet on execution, and the current $7 price is exactly where the market prices that scale-up risk.
But the risk is mitigated by the validation of the entire underlying technology platform. We aren't just betting on 007. We're betting on the PRISM platform, which has already proven its versatility and precision with the WVE-006 program for alpha-1 antitrypsin deficiency, or AATD. I mean, that Restoration 2 trial demonstrated the first ever substantial clinical correction via RNA editing. They successfully achieved the heterozygous phenotype.
Okay, that success is huge for the platform's technical credibility. I grant you that. It absolutely validates the RNA editing modality. But 007 is an RNA silencing agent targeting a completely different system. The AATD success de-risks the ability to fix certain genetic diseases. It doesn't automatically de-risk the execution risk associated with metabolic endpoints, formulation, and scaling the dosage for a chronic, widespread condition like obesity. You're conflating platform confidence with trial-specific execution certainty, and I think the market is distinguishing between the two.
And I think you underestimate the signaling power of the PRISM success. When a platform proves it can precisely correct a single base mutation in humans, institutional investors gain confidence that the underlying chemistry and delivery mechanisms are robust. This moves the needle away from, can they make the drug, to will the biology work at scale? And the genetic validation, I think, answers the latter. The market is pricing this like a phase 1 failure is still a real possibility, when the science suggests it's far more de-risked than its peers.
Well, let's pivot back to that technical suppression for a second. You highlighted the massive institutional accumulation by groups like FMR, calling it a floor. I submit that the technical data proves that the institutional bearish activity is actively neutralizing that buying power. The concentration of short activity in dark pools, that 55.6% off-exchange volume, it suggests highly sophisticated, often algorithmic, hedging strategies are dominating liquidity.
But why does it matter where the trade occurs if the net volume is still positive?
It matters because of price discovery. The dark pools essentially move institutional transactions behind a closed door, preventing the large buy orders from FMR or federated HERMAs from creating the volume spike and immediate upward price momentum they should on a lit exchange. This constant, hidden pressure is precisely why the stock remains trapped near $7. The bears are leveraging the structure to suppress the price, knowing that the company's financial needs provide a constant stream of new shares via that ATM facility. They feel comfortable sitting on their short positions.
I think that perspective fails to account for the crucial dynamic of float constriction. I see why you emphasize the suppression, but the institutional accumulation is the key mechanism designed to overcome that structural short pressure. When FMR increases its stake by a dramatic 700%, we're talking millions of shares, and Federated Hermes establishes a large position, those shares are effectively removed from the readily available active float for trading or, crucially, for borrowing. This is creating a supply shock. If the fundamental value shifts, say with positive phase 2 initiation or strong biomarker data, the high short interest becomes a massive vulnerability. We have 7.69 days to cover. Let me just emphasize that. Nearly 8 days. That's a critically tight window if the fundamentals suddenly shift, forcing the bears to cover fast. The powder keg dynamic is fueled by the fact that they have shorted over 15 million shares of a stock whose actual effective float available to cover is constantly shrinking because of these high-conviction long-term holders.
But if the float is truly shrinking and that buying is so high conviction, why has that accumulation not translated into any significant price movement outside the $7 range for months? Doesn't that prove that technical suppression and the liquidity control exerted by the dark pools are winning right now? The bears are not feeling threatened because the constant ATM dilution acts as their safety valve. Every time the flow gets a little tight, management feeds a few million new shares into the market, mitigating the very supply shock you anticipate. The $7 price isn't a floor, it's a ceiling enforced by dilution.
I disagree. The $7 price is where the short-term noise converges. FMR isn't buying for next week. They are buying for 2027. They understand that the stock is fundamentally cheap, and they are using this technical suppression as an opportunity to accumulate shares at a massive discount, making the inevitable reversal all the more violent. So let's focus on the payoff. The runway extension into Q 2027, based on current cash and committed milestones, it removes that immediate gun-to-the-head necessity of raising toxic capital at poor valuations. This breathing room, this time, is strategically crucial. It allows the core commercial thesis to play out, and that thesis is massive. WVE-007's ability to combine profound weight loss and muscle preservation positions it not just as a competitor, but as the ideal premium adjunct to the multi-billion-dollar GLP-1 market. They don't have to beat Novo Nordisk or Eli Lilly. They can complement them, significantly maximizing their total addressable market. This commercial synergy is what validates the analyst targets near $20.
I'm sorry, but I just don't believe the financing structure is strategically ideal for current shareholders. While the runway is technically extended, the structural reliance on the ATM facility means the company is consistently sacrificing small pieces of the future equity pie today. They're selling shares at $7 or $8 to fund trials that may generate blockbuster value years from now. This constant structural dilution is the tangible cost of innovation being borne by shareholders right now, and, as we discussed, it acts as an effective price ceiling.
That is a necessary cost. It's rational capital allocation. Raising money today at a $7 valuation to fund pivotal trials at de-risk assets potentially worth tens of billions is necessary. It's a far superior choice than a desperate fire sale secondary offering if cash ran low. The institutional confidence reflects a belief that the long-term payoff far outweighs the short-term cost of a few million shares being sold via the ATM.
But the market reacts to tangible events. We had a Q3 revenue miss that confirms that outside of collaboration milestones, which are lumpy and non-recurring, WVE is highly reliant on successful trial results to avoid having to resort to more substantial, highly dilutive financing later on. The financial reality puts intense pressure on execution. If the Phase 2 data is even slightly ambiguous, the technical ceiling provided by the ATM turns into a floor where sellers will gladly dump shares, knowing the company needs the cash flow. Alpha is great, but cash burn is reality, and the dilution structure keeps the power in the hands of the technical short sellers.
The technical short sellers are playing a dangerous game because they are shorting biological alpha. The data on muscle preservation is statistically significant and is genetically validated. At some point, the fundamental superiority of this asset will force the issue, and that tight days to cover metric will lead to a violent move to reprice the stock towards that fundamental $20 target.
I agree that the potential is explosive, but the current price is dictated by who has the better control of volume and liquidity. And currently, the concentrated bearish forces operating off exchange, coupled with the structural dilution necessary to maintain operations, are clearly keeping a lid on any major breakout. This is a stalemate dictated by market mechanics, not by the promise of the science.
To summarize my perspective, the data, specifically the simultaneous reduction of visceral fat and the gain of lean muscle mass, presents clear clinical superiority that structurally elevates WVE-07 above the current standard of care for obesity. This fundamental advantage, coupled with the massive, high-conviction institutional accumulation that is soaking up the available float, fundamentally suggests the current low valuation is a temporary, though persistent market inefficiency that is bound to resolve when the next key clinical data point is released.
Conversely, while I fully acknowledge that the scientific foundation is exceptionally strong, the stock remains a high-risk, high-volatility battleground defined by technical forces. Until the Phase 2 data de-risks the uncertainty inherent in that small Phase 1 sample size, and the company can substantially distance itself from the reliance on continuous ATM dilution, technical headwinds and acute execution risk will continue to define the immediate suppressed price action. The technical forces are currently winning the short-term battle against the fundamentals.
We have examined the profound asymmetry in WV, weighing the strength of the ion light trial results and PRISM platform validation, representing clear biological alpha against the technical suppression from high short interest and financial pressures like the constant ATM dilution. Both the clinical roadmap and the market microstructure present compelling cases for extreme volatility and potential movement in either direction based on upcoming news.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.